Shall I invest in index funds or active mid-cap funds? Why the active fund corrects more than index during the corrections? Is it make sense to make more money in active funds during the rally? Now investors are having a lot of confusions. Market have started to correct. It is substantially corrected in the last 6 months. The mid caps have especially and small caps have corrected quite a good in the last 6 months time, maybe 13-15% have got corrected. And this gives an opportunity for investors to think, do we need to invest in a index funds or we need to go with the active funds? We see that normally we saw when markets are getting corrected, the index falls less than the active funds. Why? Because we saw that in the last 6 months time, index funds have corrected lesser than the active funds. Why? Because index funds takes lesser risk, whereas the active fund takes slightly higher risk because they don't invest technically with top 101 company, 250 companies. They invest outside of that. That is the reason the active funds correct far higher than the index funds during the correction. So because a fund which instead of investing 100 rupees in a mid-cap stock, they take 60 to 70% in a mid-cap and 30% they try to invest in small cap. So when market corrects, it corrects 70% towards a mid-cap and 30% towards a mid-cap. So that is why we see the markets of active funds correct faster than the index, and thereby it creates a more loss for investors. But similarly, the vice versa, the market getting bounced back, it not doesn't correct, it goes only with the mid cap index, it also goes with along with the small cap. So now the markets have corrected substantially. Is it not a right time for us to put every money into the mid cap, because we are not sure where is the bottom is there. The outcome of the Ukraine-Russia war and how it is going to pan out and how it is going to impact the fuel price and in turns the inflation is going to decide how the markets across the globe is going to turn, along with the increase in interest quantum in US markets. So if the markets are getting corrected very faster, there is a possibility for investors to start moving quite a good money. And none of the investors, not the expert, also doesn't know what is the bottom of the market. So we cannot able to identify the market and try to invest. So assume you are anticipating market may bounce back in 2-3 months time or 1 quarter or 2 quarter. So that's a great idea to stagger your investments over next couple of months time. And whenever the market corrects by 3 to 4% or something like, instead of moving money on a daily basis, you can move 5-10% on that particular day and try to continue your systematic transfer plan from your liquid fund or money market fund. Thereby, you can have the ability to take higher returns on that. So now let's see why we not go with the index fund, why you need to go with the active funds. Normally in India, the index funds are rebalanced on a quarterly basis. Either in the March, June, September and December it is getting rebalanced. For example, this particular quarter, the good sector which is getting corrected by more, it doesn't have an opportunity in the April for reconstitution in the rebalancing in the index. Probably they have to wait entire 1 quarter for rebalancing. The fund manager has an ability to decide depending upon market situation. He need not wait for a quarter or 2 quarters to decide which stocks he need to pick. He finds a good quality stocks have been beaten down due to the external factors and it has a potential to bounce back. He will try to increase higher weightage to that particular stocks. That is why the active fund manager has an ability to do better than the index. We also see a lot of articles read that the large cap funds try to struggle the index. It's true, because most of the time the large cap funds will try to find very difficult to beat large cap index. That will be Sensex or Nifty, because there are a lot of various data is available for everybody on the Nifty 50 or BSE 30. So that is why for the fund manager to beat the index always it's become a challenge. But whereas in a mid cap, typically a mid cap fund will invest only 150 stocks, whereas the mid cap active funds doesn't invest within only within the band of 150 stocks. They have an ability to go beyond that. They need not restrict with 150 stock, whereas in a large cap, it is not like that. They predominantly they concentrate on, if we have to reduce the risk and if you go by the mandate, they should only invest within the top 100 companies, or among the Sensex or Nifty 50, they can decide the weight, which weight they have to do. That's why when compared to large cap, mid and small cap, the fund managers ability and the research department they have, and then the ability to pick the stock plays a major role in the returns. The last 1 year time, let's see, like the Midcap in the BSE Midcap has given close to around 7.5 to 7.6% return, whereas we saw that some of the funds have given 35%. That means a clear alpha of close to around 27-28% has given. Now there will be some investors asking, if you invest in index, we can save 0.5% or 1/4%. That's not going to be great difference, because when the difference is so huge, there is no point in looking at an index to do that. Let's see, like out of 30 index active mid-cap schemes, only 4 have trailed the benchmark of BSE Midcap. Rest of all have beaten the benchmark by substantial margins. At least half a dozen active fund have delivered beyond 15% plus. So that means that clearly shows the ability of the fund manager to identify the stocks and pick at the right time and able to journey along with that rally. So that clearly gives an opportunity. So if you are an investor looking for investments into mid-cap, don't look at index funds. There is a possibility you can able to earn more return in the active fund. So my suggestion to investors is that try to invest in a liquid fund. From there, try to do a systematic transfer plan depending upon your risk appetite. Either try to do on daily basis or weekly basis or monthly basis, whatever it is, your choice. And along with that, whenever you find the opportunities, try to move 5 to 10%. On top of that, you are also good, you can able to identify which sector is likely to go faster after the market settle down. You can go with a fund which has a higher weight but particular sector or particular set of stocks which has a ability to do. For example, you think consumer durables has been beaten down as a potential to go, or fast moving consumer goods which has been corrected 10-15% in this recent corrections, or the IT stocks which has corrected during this period of time, or pharma stock which is corrected. You feel that particular IT stocks may bounce back, or you feel that FMCG may bounce back, or you think that auto, because of the fuel price going up, auto stocks have been corrected substantially. You think that when prices jumps, there is a possibility of automobile bounces back, or you think the commercial vehicle segment likely to go. Depending upon individual choice, you can select the sector and see which fund has a higher weight to that particular sector and try to go and invest in that. There is every possibility you can able to generate higher alpha than the index. So my suggestion is that select the scheme which you are like, and then go to the parameters, look at the price earning of that particular active scheme, and also look at the sector weight on those particular schemes where you have a higher weight. Is that particular sector weight is your choice, then you can go and invest in active fund. You can stagger for couple of months time to get a better pricing or better cost averaging. It's not better pricing, it's going to get a better cost averaging that will help you to earn better return over a 3 and 5 year period of time. So this is Suresh Parthasarathy, certified financial planner and founder Mindset Consultation, signing off. We'll meet some other video. I request those who want to know about my views on market, please subscribe my YouTube channel. Bye.